Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 13th of September 2019. And as it is Friday the 13th, we thought we would share with you something a little different today. How some banks manipulate precious metals and other commodity markets, but particularly the gold and silver markets, via a practice called spoofing. So, here goes. Let's investigate. Over the years, we have heard precious metal pumpers, in particular, state that gold and silver prices are manipulated. The governments and central banks cannot afford for gold or silver to rise above a certain point, and this is why prices have been held so low. What is interesting is that they say this to convince all of us during that period that gold and silver prices should be 5 times, 10 times, or even 100 times higher than they are now. So you should rush out and buy as much as you can before it's too late. Often quoting the rather infamous term, better a year early than a day late. They then produce a metric showing, for example, and the US debt clock is a common one, found at usdebtclock.org, which currently shows the national debt at $22.5 trillion. The dollar to gold ratio at $6,625, and the dollar to silver ratio at $804. So they claim that gold should be a minimum of $6,625 and silver $804 an ounce. Now, there are many problems with interpreting this ratio in this way, not least being that if those figures were accurate, the gold to silver ratio would be just 8 to 1. And there are a myriad of reasons why this cannot be justified or is simply not going to happen. Well, until at least silver actually becomes scarce in the Earth's crust. Note from geologists, it's not that scarce yet. Now, we shall discuss these figures further in a future video, but for today we shall merely point out for information purposes that the dollar to silver ratio represents the year-over-year increase in the US M2 money supply divided by the yearly production of silver in ounces, and the dollar to gold ratio represents the year-over-year increase in the US M2 money supply divided by the yearly production of gold in ounces. And as I've mentioned, we shall cover this again in a future video. So, the common theme goes, well, the fact gold and silver are not that price proves the market is manipulated. Well, ask yourself a simple question. If the central banks were so worried about gold and silver rising, why did they let gold prices rise to almost $1,900 from just $252, a 750% growth over a period of 25 years? And silver prices rise to $50 from just $4, a 1,200% growth over a similar period. With gold currently at $15.05 and silver at $18.15, that still represents a 600% and 450% growth respectively since then. Do you really believe that the Fed gives a damn if gold rises another few $100s and silver rises another $20 to $30 an ounce, reaching previous peaks? We don't think so. They've much bigger fish to fry. What is true, however, is that these prices have been manipulated via the paper markets. Not necessarily so much by central banks and governments, but by some bullion banks, investment funds, and larger traders. And this is achieved because the paper markets operate anywhere between 100 to 200 to 1 the physical market. This is essentially what is called leverage, and the figures can be so vast, they of course influence the underlying price. Now, We aren't saying central banks have never intervened. That would be naive. The Plunge Protection Team, which was set up by Ronald Reagan, was created to advise presidents and their financial secretaries on how to deal with unruly markets. Generally, stock markets. That is, to prevent a similar crash to that experienced in 1988. Now, many attribute the Plunge Protection Team to being actively involved in meddling with markets. And frankly, no one outside the administration can prove either way whether this is true or not, though occasionally there are suspicious trading activities from time to time. Now, let's get back to where we believe most of the manipulation actually does take place. With gold and trading banks such as JPMorgan, for example. Now, JPMorgan, one of the largest gold trading banks in the world, said in an August regulatory filing it is, quote, responding to and cooperating with, unquote, investigations by various authorities, including the Department of Justice, relating to trading practices in the metals markets. Now, we have previously seen 2 JPMorgan staff plead guilty in a criminal market manipulation investigation. And Reuters reported yesterday that 2 current staff, a Michael Novak, MD and Global Head of Base and Precious Metals Trading in New York, and a Greg Smith, who are reportedly on leave, though to date they've not been charged with a crime. Now, without us casting aspersions on the activities of these latter 2, we shall address what the former 2 employees have pleaded guilty to in this criminal investigation. In November 2018, John Edmonds, aged 36, pleaded guilty to 1 count of commodities fraud and 1 count each of conspiracy to commit wire fraud, price manipulation, and spoofing. He'd been with JPMorgan for 13 years at their New York office. As part of his plea, Edmonds said that from 2009 through 2015, he conspired with other JPMorgan traders to manipulate the prices of gold, silver, platinum, and palladium futures contracts on exchanges run by the CME Group. In August 2019, Christian Truntz, aged 34, from London originally, pleaded guilty to criminal charges of manipulating the precious metals markets for 9 years. He pleaded guilty to 1 count of conspiracy and 1 count of spoofing in the US District Court in Brooklyn. In his guilty plea, Truntz admitted that from approximately July 2007 and August 2016, he, quote, placed thousands of orders that he did not intend to execute for gold, silver, platinum, and palladium futures contracts, unquote. There it is again, spoofing, a tried and tested method of market manipulation, providing you don't get caught, that is. So what is it? Well, spoofing is a strategy that involves placing trade orders with the intent to cancel them before they can be executed. The goal is to affect the price of the commodity and benefit a pre-existing trading position. Francine McKenna wrote a wonderful piece for Market Watch on this subject back on the 25th of June 2019, involving another bank. But this article explains the spoofing practice quite eloquently. Quote, Merrill Lynch's global commodities trading business agreed to pay $25 million and enter into a non-prosecution agreement with the Department of Justice on Tuesday to settle charges regarding a multi-year scheme by its precious metals traders to mislead the market for precious metals futures contracts traded on the Commodity Exchange, Inc. Merrill Lynch admitted to the allegations that beginning by at least 2008 and continuing through 2014, its precious metal traders schemed to deceive other market participants by injecting materially false and misleading information into the precious metals futures market by placing fraudulent spoof orders for precious metals futures contracts that, at the time, the traders placed thousands of fraudulent orders they intended to cancel before execution. The intention was to manipulate the market by creating the false impression of increased supply or demand, and, in turn, to fraudulently induce other market participants to buy and to sell futures contracts at quantities, prices, and times that they otherwise likely would not have done so." Unquote. I hope it hasn't gone past you to realize 2008 to 2014 represents some 3 or 4 years of major market growth in the price of gold and silver and a couple of years of its decline. So it's not all one way. Now, Aziz Abdelkader, in an article for Finance Magnates, reported on the 25th of July 2019 the following, quote, "Regulators and exchanges have stepped up their policing of spoofing in recent years. However, the people and firms they previously focused on were rather small-time avid gamers in the markets. This has changed recently, as big banks such as Deutsche Bank, HSBC and UBS were hit by penalties, the largest of which was a $30 million fine for Germany's biggest bank. The Swiss bank UBS has also found itself facing similar accusations after some of its spot traders used phony trade orders to manipulate precious metal futures traded on the COMEX. The bank agreed to pay a penalty of $15 million to settle the spoofing charges brought by the CFTC. Spoofing in general is a practice in which a trader floods the market with fake orders by entering and quickly cancelling large buy or sell orders on an exchange to fool other traders into thinking the market is poised to rise or fall. Though the tactic has long been used by some traders, regulators began clamping down on the practice only a few years ago." Unquote. Can you see a pattern developing here? We have, over the years, since the channel began, to some extent, attempted to curtail subscribers' attacks on the Fed and government for deliberately manipulating gold and silver markets, even when those accusers cited examples of short-term price manipulation. We haven't done this because we're apologists for the Fed or the US government or involved in a cover-up protecting them, but because we have always held the view that in the majority of cases, these manipulations were conducted not necessarily by some supremo attempting to get the Fed out of a sticky situation, but by greedy banks and or their traders, who are paid enormous bonuses for profit maximization, who simply saw a quick and effective way of making a few million or billion dollars with relatively little risk of being found out or proven. In many cases when they have been caught, they've merely been fined. But now criminal charges are being brought against some. Perhaps this may make others think twice, though we're not totally relying on that happening. So, when a pumper tells you it's the Fed or central bank manipulating the price down in order not to allow gold or silver to be deemed by many as an alternative form of money, we would just ask you to think twice sometimes. And wonder, when there have been large price movements, is it really the Fed or perhaps some greedy trader taking advantage of an opportunity? In any case, such moves and activities generally only last for relatively short periods of time and often account for major intraday large price movements. We hope you found that useful. Do share your thoughts. We welcome them whether you agree or disagree, providing, of course, you do it politely. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners. Glory, glory, hallelujah.